we've got a program called Rate Secure. And Rate Secure it's not a locked rate, but we put a ceiling. We tell the clients, okay, now that you're a certified home buyer, we can give you a rate secure for 90 days and we'll put a ceiling on your rate. And it can't go any higher for the 90 days. But at the time you're ready to buy, if the rates are lower, we get the lower rate. But we're protected throughout the 90-day period. And then we can increase it for another 90 once we get their file recertified. And what that does is two things. It gives them peace of mind, but for the real estate agents themselves, they know they still have a qualified buyer. We've heard really sad stories where people were pre-approved by a lender and then the rates went up and they no longer qualified. And so the house that they want passed them by. So we offer a program at no cost to the consumer, and it kind of covers the best of both worlds. Your loan's approved and your rate's protected, but not locked in. We just put like a ceiling, like a safety net, above them, knowing that they can't go any higher and they're still within the qualified boundaries of their loan approval.
Yeah, that's pretty cool.
Yeah.
Welcome to B2B Synergy, the Power Partners USA podcast, your exclusive guide to discovering the potential of B2B partnerships. I'm Alan Armijo, owner of Power Partners USA, business-to-business introduction and referral service. Our members are B2B professionals who team up to provide each other repeat referral business or collaboration. Today's episode shines a light on Jack Senske, branch manager of Churchill Mortgage and new Power Partner USA member. Jack, I'm really looking forward to this conversation in order to give everyone a firsthand understanding of your work in residential mortgages. I also want to welcome you into the growing real estate sector of our business network.
Thank you. I look forward to chatting with you today and sharing what I know and hopefully offering some good information.
Great. Thank you. Could you explain your role with residential mortgages and in terms of working for a mortgage bank?
A mortgage bank is not a bank itself. It is a facilitator for loans. We originate loans, we fund loans with our own funds, and then we either keep those loans and service them ourselves, which means collect the payments, or we sell the loan off to investors and then recoup our money and then are able to loan again. The difference between that and a mortgage broker is a mortgage broker doesn't use their own funds. They're always assigning the loans to either a mortgage banker or a bank itself or another investor who uses their money. So we kind of are in the sweet spot where we're able to somewhat do things our own way as long as we're in the guidelines of the program that we're offering. And then my role in that is that I'm the point man with the public. My clients are just everyday people that are looking to finance real estate, either refinance a property they have or purchase a property. We do a lot of business with investors, people that buy property for rental purposes. And we do a lot of business with people that are buying to live in, and a lot of first-time home buyers that we coach and guide along the way. So I am that guy that deals with the people and then puts the paperwork together from the people in the hands of our underwriter, who then scrutinizes the file and issues a loan approval. And then we go ahead and close. I'm the face of the lender, basically, to the public.
So traditionally, in my view, there's a realtor involved. Is your client the realtor or the end user, the public, or both?
So the realtor and I both share the client. The realtor refers to the client as their buyer, and I refer to my client as the borrower, basically. I get referred the business from the real estate agent many times. And so we work very closely together because the transaction, if there is financing involved, everything is relied upon the financing going smoothly and successfully. So we're partners in the same transaction. They're representing the buyer on the details of the real estate purchase, the contract and such, and I am handling the financing part of it. So yeah, we're arm in arm, lockstep, working with the same people.
Okay. So you mentioned some of the products like refinancing, but are there any specific other products that you work with? I'm referring to like non-QM loans. What is that?
Qualified mortgage, or QM, or the loans that fit into the guidelines of Freddie Mac, Fannie Mae, government, FHA, VA. Those loans have rigid guidelines and you've got to stay within those guidelines. And those guidelines, for example, would be the debt to income ratio. It has to stay under a certain amount. the down payment amount, all of these things. There's a long list of guidelines and credit scores and everything you have to adhere to in order to stay in the QM lane. Then there's non-QM loans, and there's a whole other plethora of lending sources for the non-QM. Non-QM, for example, would be for a guy that makes a lot of money but doesn't claim a lot on his taxes. We can use 12 months bank statements and average his deposits and use that for income instead. That would never qualify for a QM loan, but for a non-QM loan, they're plentiful out there. And we have loans that investors that don't need to qualify, they don't need to provide any income documentation. The non-QM lenders will base the loan decision on the potential income on the property, like the market rent on the property. So those are just a couple of examples of non-QM, but traditional vanilla 30-year fixed rate guideline loans will fall into the QM. And that's primarily probably 80% of my business. And then the other 20% is for those folks that don't fit into that category, but still, very good and qualified buyers on their own.
What is your territory?
So the company is licensed in all 50 states, and I am licensed in California, Arizona, Nevada, and Michigan, and Colorado. So I can do business in all the states. I just refer it to another loan officer in the company, and I'm still involved in the transaction. Or if those states I just mentioned, I handle the transaction directly. So I'm not limited to a geographic territory.
And what would you say your areas of specialization? How do you differentiate yourself from other mortgage banks or mortgage brokers?
So I've been doing this a long time, somewhere around maybe 45 years I've been doing this. And so along the way, you just learn a few tricks of the trade. I think the thing that I like to claim that I do well is put deals together that may not seem like a deal. I've had several instances where people will come to me saying, I've already been to another lender and they can't help me. They can't get me a loan. And then, will you try? Using some of that experience, some of the, tricks of the trade, like I said before, I can make those deals go together. I'm pretty good at analyzing tax returns and getting income out of tax returns where there doesn't seem to be any positive income. And so I like to be able to, tell people I can really, really take a good deep dive into their finances. And if there's a way to get them financing, I'll be able to figure out how.
Okay. So do your rates as a mortgage bank different in any way?
Well, the QM loans, the Freddie Mac, Fannie Mae, VA, FHA loans, all of that pool of funds are competitive across the board, lender to lender, broker to broker. If someone's always going to be the lowest, someone's always going to be the highest. We're kind of closer to being the lowest. We'll never be the lowest, nor do we want to be that guy. We claim that our rates are competitive, but really what you're getting when you do business with Churchill, you're getting to do business with me and my experience. So we pride ourselves in the service we offer our clients, not only during the loan transaction, but well after it closes. We do annual reviews on the mortgages, and we're a constant partner with them. It's just not a one and done for us. So yes, our rates are similar and competitive, but like I said, we'll never be the lowest.
Okay. All right. So let's talk a little bit about your client makeup. Can you explain your clients?
So it's all over the board. First timers, coming out of a divorce, retired people, and everybody in between.
So what would you say are like some misconceptions or things that people don't know about? But do people come in with misconceptions of that, I can't get this loan A
lot of times, yeah, they'll come and say, this is what we want to do. How can you help me achieve my goal? And then I say, well, let's look at all the pieces of the puzzle. Let's see what your income is. Let's see what your assets are. Let's see what you want to buy. Let's see what you can afford. And let's just kind of put it all together. And then I'll give you a proposal or a couple of options for you on how you can achieve that. But so misconceptions are sometimes people come in with an attitude or a thought, and sometimes they don't even come in. They just think there's no way I can buy a house. There's no way I can afford to buy a house. There's no way because of this, because of my credit. There's no way because I don't have any money. There's no way, And so all of those barriers that people have already misconstrued, we have to kind of overcome those and explain, yes, you can. This is the reality of it. This is, sometimes the reality is you're right. You can't afford right now. But we never turn people totally away. I'm working with people that came to me with, inferior credit, and it prevented them from really joining into the borrowing field, if you would. So we're working with them on their credit, and we've been successful in telling them what to do and how to do and getting their credit score up 50, 60, 80 points. And so now they're back in the qualified borrower range. So it's one of those things. We can't help people immediately all the time, but we nurture them along until we can.
Okay. All right. As a reminder to everybody, Power Partners is a B2B introduction service. We introduce business professionals to each other who can provide each other repeat leads and referrals or do business collaboration. We are targeting this podcast to your Power Partners, Jack, to bring you more repeat referral business. Who are your Power Partners that give you business, and how do you work with them to benefit you and them and the client?
So the natural resource has always been real estate agents. They're the people that are directly involved. They're the people that have clients that need the clients to get pre-approved. And so they'll send them to us. But before the search begins, basically, the clients, my real estate clients, will send them and say, we need to know what they can afford before we waste any time looking. So that's the natural one. But I get a good amount of business from accountants. I get a good amount of business from financial planners. Most of that business comes when the rates are a little bit more competitive and there's refinance business out there because their clients are coming to them saying, hey, I think it's a good idea. I want to refinance. And can you refer anybody to me? And so a lot of times those people, the CPAs and financial planners, will refer clients to me. But I've gotten business from divorce attorneys. Most of my business comes from people that I've done business with before, and they refer a friend or a family member or something along those lines. And that's really what we try to do, make this unbreakable chain of just continuing to offer great service and performance. And then those people are our best salespeople, our customers.
Do you think that rates will come down and more referrals be coming in because of that, based on what you said?
Yes. And they are coming down. They're slowly but surely. We peaked, and there's talk that the Feds are going to lower the rate probably as early as September. There's some slight chance they may lower them at the end of this month when they meet, but it's probably unlikely. Just because of the feeling, and everybody's assured that the rate cuts are coming, the bond market and the interest rate market is reacting to that already. So we're seeing our rates starting to come down. They don't come down near as fast as they go up, unfortunately, but throughout this next quarter and first quarter of 25, I think the rates will be significantly lower than they are now.
So from where you said, what do you keep your eye on with regard to rates and things like that? Because it sounds like as a consumer here, I'm like, oh, okay, the rates are going to come down, but you've already been thinking about it, right? The wheels have already been in motion, which I don't have privy to. What should we watch out for? Is there a wait and see, or?
Yeah, and it's always good to check, because a lot of times by the time the public figures it out, whatever's happened has happened a week before. I belong to a couple of different financial services that just do this directly. They monitor the interest rates, the futures. Mortgage-backed securities are basically what dictates our interest rate. So I look at that several times a day, but for the public, if you can just find a place to look where the 10-year treasury yield is going, what direction is it going? Is that yield getting lower or is it getting higher? And as that goes, the interest rate goes. So that yield right now is probably about, I haven't checked in the last hour, it's probably about 4.15, 4.17, and back in the day, it was maybe single digit. But so why watch that? And that's been coming down little by little. So if you wanted to watch it on a weekly or daily basis, if you can find a place that tracks that 10-year treasury yield, that would kind of give you an indication of what direction we're going in. So, but I look at interest rates in the market. I have to, just to cover my pipeline, and we need to be able to lock a rate in before there's a rate increase. Because if things go south in the middle of a day and we're getting alerts from these services that we have, a lot of times we'll pay attention and lock our customer's loan, their rate in that day before my lender raises the rate. So we get a little bit of a heads up that way.
Would they be relying on you for the best decision when to do things?
Yes. I like to collaborate with them because I like them kind of involved, and they're the ultimate, decision maker. Should we lock or should we not? But I influence their decision quite a bit, saying what my opinion is. So they trust me a lot when it comes to that. It's just, because I've got my finger on the pulse, if you would.
Well, so when the rates are going up, you're telling them hey, you should lock it in now, but when the
Yes.
rates are going down, you tell them to wait a little bit?
So here's something. It's a good segue for me to go into our company. Let me start with Churchill Mortgage. So Churchill checked all the boxes. They were 30 years old at the time that I looked at them. They're debt free and have been debt free for a long time. They've got a bunch of cash reserves to be able to fund future expansion in the form of technology and such. So they're going to be not only debt free, but be able to keep up to speed with the rest of the industry. They're 100% employee owned, which means after a couple of years, I'm a vested owner. And what that's not as important as it tells me that the company really can't be sold without the agreement of all the employees. So we're not going to go anywhere. We're going to be here for a long time. The guy that founded the company is still involved. The management are top notch, and there's just very few layers between me and the top. And so Churchill has they've just got a great foundation. They're expanding a little bit in different markets and will probably expand more as the industry evolves even and shrinks even more. And then not only that, they have this unique program where I explained a little bit before, but it's called the Certified Home Buyer, where we're able to take our clients and go get them all the way through underwriting before they find a house. We give them a certification that says they're a certified home buyer. In addition, we offer a rate secure program. It goes tandem with the certified home buyer. And that rate secure will put up like a ceiling on the maximum their interest rate could go while they're shopping for a house. But the benefit of that is that the rate is not locked. It's just protected and can't go any higher than a certain amount. So if the market drops or at some point right when we're ready to close their transaction, we get the benefit of the lowest market or the lowest rate at the time. So it's way better than being locked in. It's the best of both worlds. We get to get the market rate at the time, but we know we're protected. And for the real estate agent community, it's been really helpful because that client stays qualified throughout the 90 days because we know their maximum rate. We know they're qualified for that maximum rate. And like I said, on some sad situations before, people that didn't have this with another lender, they became from qualified to out of the market because the rates went up and they couldn't qualify anymore. So all of those things really endeared me to Churchill, and the people, of course, and the culture is really good. They're the only mortgage company advertised on the Dave Ramsey show, and we're the only mortgage company that's ever been a sponsor of that show. So that's another kind of feather in the cap. So Churchill got really good backing behind me. And so with that, I'm able to do what I do best, and that's go and help my clients, buy houses or refinance houses.
What about, back to your power partners, like say an estate planner or a CPA, financial advisor who might have a client who wants to do some investment properties or things like that in terms of homes? Why is that like a more complicated mortgage that you would be involved with, or is it also one of the things you do?
For new investors looking to buy rental properties, we've got programs now that enable pretty much anybody that has a down payment and decent credit to be able to buy a rental property. And it's, there's a different cutoff. The cutoff with the traditional QM and non-QM loans is 4 units, 1 unit, 2 unit, 3 unit, and 4 unit. Once you get into a 5 unit property, then it becomes a different category, more like a commercial loan almost. So in that 1 to 4 units, if that's what they're buying, then no, it's the same nuts and bolts for any kind of loan. The non-QM can be much easier and more streamlined because many of the programs don't require as much paperwork as the QM loans. So we have all of those options, and those non-QM rates are becoming really, really competitive with the QM rates now. So it's a lot of choices for buyers and borrowers now. But yes, that's exactly what we do. We give them the options. We show them what the new payments would be. They're going to need to know because they're going to want to know what their cash flow is going to be, the potential income compared to what the payments are going to be, and the cost of running the property. So yep, we do that all the time.
Okay. And so then working with power partners or other professionals, what referrals do you tend to give?
So during my transactions, all the transactions I do, I probably mention at least 3 times to the borrower, who generally came from the realtor, okay, how fantastic their realtor is, and do they know somebody in their circle of friends they think they can refer the realtor partner. And so That's a constant reminder. So that's one way I try to give back to the real estate partner. I asked the clients during the scope of our investigating, I said, do you have an accountant? Do you have a financial planner? And a lot of times they'll say no. And then I would say, well, boy, I'm in a group that I've got a fantastic referral for you. So it would be that way. But it's one of those things. It's the more I get to know what the partners do, I'm involved in do, it's kind of top of mind. You start asking a little bit more, direct questions.
Yeah, because these leads mostly pop up in conversation and you realize, hey, that could be a big deal, for somebody. At what point in the home buying process do you come in?
My ideal situation is to have the borrower's loan approved and packaged and ready to go before they actually begin the house hunt. That's ideal for me. If I get in after they're under contract, it normally doesn't happen like that anymore. It used to happen like that all the time. The realtors would call me up and say, hey, I just signed a new contract. We're in escrow. Can you help my client get financing? But now, because it's competitive, there's very much many deals. There's quite a bit fewer deals going around. It's more competitive. And so we try to get to the buyer sooner than later to help the agent to get that part of the transaction done. So yeah, 30 days before is great. Even 2 weeks before we can get them done. I can get the loan approved and everything ready to go in probably a week if I needed to. But it takes the pressure off the transaction, knowing that the loan, which is a huge part of closing the escrow, if it's done ahead of time. So yeah, ideally, anywhere from 6 months out. I've worked with a lady now for over 1.5 years. She just keeps trying to find the right property. So, it's not unusual now.
So how do you qualify the clients or assess their specific needs when it comes to getting that mortgage ready?
I like to ask them what their monthly budget is, especially if they're new to the business. If they're a first-time buyer, I try to get them out of their comfort zone of what they're paying in rent right now compared to what they may have to pay in a mortgage. And so we kind of have to go on new ground there. The specifics of getting them qualified, it just depends on what their employment situation is. If they're an employee, then we do pay stubs and W-2s. If we need to calculate if they have overtime in there, we kind of break it down that way. If they're self-employed, then I need to look at tax returns. Do they own their own LLC? Do they own an S corporation? We got to get the corporate tax returns and analyze those. And then I come up with a monthly number, gross monthly number after expenses and before taxes, and then use that for the qualification purposes. Generally, to make it simple, you're able to spend about 50% of your gross monthly income. That includes your new house payment and all of your current obligations, card payments, credit cards, student loans, so on and so forth. So,
can you repeat that? So you have to have like an extra 50 available after all that?
Yeah. And that's again, before taxes. So if somebody's making $120,000 a year, that's $10,000 a month. That means that we can spend $5,000 on their new house payment, including all their other debt. If they have, $1,500 in debt, makes the maximum house payment $3,500, and that includes property taxes and homeowners insurance. So I kind of back into it to figure out exactly the maximum payment based on current rates, and then we kind of work backwards into the loan amount that way. That's the way I do it anyway. Or if they say, hey, I found a house at $700,000, and I want to put $200 down, can I qualify for $500,000? And then we'll do it the other way. We'll figure out the payment, what they make. And then at the end of it all, they still got to be able to justify their monthly income. And I've got to do it calculations in the proper way that's going to pass muster with the underwriters. That we can't just wing it at the front end and then send it in and hope the underwriters agree with us. It's too precarious that way. So we're pretty conservative at the front end to get them qualified and to get what income they have. The credit report dictates their debt. So there's really no hiding that, right? Whatever shows up on the credit report is basically what we use unless they're going to pay some stuff off. So we're trying to get to the DTI, the debt to income ratio. And that is the new house payment plus all of their debt divided by their gross income. And it gives us that ratio. And we need to stay under 50%.
Has it always been 50% or has it got a little more stricter since say 2000?
No, 50 is kind of the top end. And then, back in the day, the guidelines say like 33%, 45%, it's been different. And again, it's a little bit lower depending on the down payment. If you're only putting 5% down, you've got to get mortgage insurance, which is the lender gets insurance because it's a riskier loan. They make the borrower pay for the insurance that benefits the lender in case the loan defaults. And so the mortgage insurance, that's another set of eyes that have to look at it. Their underwriters have to look at it per se, and they have their own guidelines. And so if your debt to income ratio is higher than 45% and you need mortgage insurance, your premium, your monthly premium that you pay with your house payment is almost double. So again, you can still get the insurance, but it's a lot riskier over 45%, and it's 45.1, and it's like etched in stone, 45 or lower.
And you have to have like 20% down payment, right?
You don't have to. You can get by with 3.5%, 3%, 5%. Again, with that comes the burden of mortgage insurance. The public knows it as PMI, private mortgage insurance, but it's just part of the cost of the deal. You just have fewer dollars to put down, so you pay a little bit more a month because of this mortgage insurance. But otherwise, you're not going to be able to get the loan. Now, we could structure a new 80% first trust deed, and then add on top of that at the same time an equity line of credit that goes in second position for, let's say, 10%. So 80% on the first, 10% on the second. And then the borrower would come in with 10% to make the transaction complete. And to do it that way, we don't need mortgage insurance. We can avoid it altogether because the first trust deed is 80% or less. Okay. So there's ways around the mortgage insurance if you have 10% down.
So how did you say is the best way to qualify clients for you in these different regards? Because typically we're conditioned to, make that referral to the realtor, not the mortgage broker. Now that you said, they're thinking in a year, it's like, and you should talk to your mortgage broker right away. But in all these cases, they can talk to you first or the realtor or at the same time, I would assume.
Their livelihood depends on these escrows closing. And like I said, 90% of the potential problem in an escrow is going to come with the financing. So they got to say, when I'm giving you a client, Mr. Lender, I'm depending on you to get it to the finish line so we can all get paid. I would talk to people before they even have real estate agents. I run into them sooner. And that's another way I can give referrals directly, deliver a packaged, a pre-approved borrower to a real estate agent is like a windfall for them. So I like to get to them first before they're with their agent, just because I'm selfish.
Well, I mean, this is what I like about these podcasts is I learn so much and just, kind of bringing all these pieces of the puzzle in.
Yeah.
I'm viewing these referrals differently now when I'm getting them or setting them up. So
I totally agree. The more you know about the other partner, the easier it is for you to get referrals to. You're like another salesman for that partner,
Sure.
That works out.
Okay, good. What is the process for assessing and updating a residential mortgage over time as circumstances and needs change, and obviously interest rates? Is there any other reason to refinance or you to become involved again?
So we have an annual review we schedule with our clients, and we talk to them every year. And it's not specifically about the mortgage, just about what's changed in their life. They could have had another child. They could be bursting at the seams. They could be thinking about, I think this is the year we're going to move. So that annual review, not only we talk about the mortgage and is it still good for them, but also about their other finances. We like to coach them up about, what's going on and, do they need any advice or any direction on what to do as far as investing? Another chance for us to refer somebody. And so those annual reviews are just basically to keep in touch. But if it's time and if it's right, I'll call clients right away specifically to refinance because I know what their rate is now. And if we can beat that rate by a significant amount, I try to beat it by at least 1 percentage point. I'll call them on the phone and say, you may not know it yet, but it's time to go. Let's go. And they're counting on me for that. When we close their deals, they're counting on me. Let me know when the rates are good. I want to lower my payment.
You mentioned, or a lot of mortgage companies sell to other like you said, to other banks or whatever. Do you keep a lot of yours, or do they also get sold too?
Well, in this market that we're in right now, and it's been a really tough market for the real estate lending community, you get a added bonus if you sell your loans now, the servicing. And it's not as attractive now with the rates as what they've been for the last 2 years, because most of those loans, in most everybody's opinion, those rates are high enough that they're going to get refinanced and those loans are going to get paid off. So I think the lenders today are trying to maximize their profits on each deal. And I think we're selling more, if not all of our loans, or at least the servicing part of it as the deals close. We have a lot of loans that we're still servicing now in the low 3%, 2% when they were low 3-4 years ago. And because those loans won't ever get paid off, probably, most of them, unless people have to move or whatever the case is. But now I think we're selling most everything that we get just to maximize the profit and the margins on the transaction as they close.
So somebody else becomes the lender.
Yeah. There's lenders that aren't really lenders. That's all they do is servicing. That's their main business. And so they really aren't out on the street originating. They're just buying the loans on the back end. So it's not really a big competition for us. You would think that maybe another lender is going to get in their head and they would be that person to call first. But I think with our communication with our clients, we stay top of mind with them.
So if you sell the loan to somebody else, is the client still yours? You still take care of the client?
I'm still taking care of them, even though they're paying somebody other than Churchill every month. Yes.
Oh, okay. So it doesn't matter to you?
No. I mean, I wish it was still Churchill. A company that I worked before, they kept most of their servicing, but that was when the rates were low. And when they send out the mortgage statements, my picture and contact information was on every mortgage statement to all of my clients.
Yeah, because to me, like a lot of, in my experience, the mortgage broker was faceless. I didn't know who they were even,
Yeah.
Realtor.
Our database, we guard them, we covet them, we service them, we take care of them. That was hard business to earn. We want to keep it.
Good to know. That's different. I don't have any other questions unless there's anything I missed or anything you're going to add.
Just want to make sure people know that when they engage with me, they're going to get the straight answer. They're going to get the maximum effort and probably more experience than they could find anywhere else in the industry.
Yeah. Well, like I said, I learned so much in these podcast interviews. Thank you for your time. Appreciate you joining Power Partners. Looking forward to making you more connections and bringing you that repeat business.
Yeah. And I'm looking forward to, dishing out referrals as much as I can as soon as I get to know people. And I've got that on my target list to try to just knock them off one by one, have a face-to-face or at least a good long phone call with them to kind of get to know them a little bit better. So looking forward to that. They all seem like great people.
They are. Well, thank you. Appreciate it.